morning. Thank you to Kantar for inviting me. It's an absolute delight to be here. I think I'm in a safe space this morning to declare that brands and their stewards in the marketing team do matter. And as we've heard a couple of times already this morning, the sage of Omaha, Warren Buffett himself, agrees that brands do matter. But I think, well, that poll there, that very scientific poll that Thomas just conducted, does reveal that not everybody takes the words of the most famous investor in the world even as gospel. I think if one subject, one theme has dominated my time as editor of Marketing Week, it's marketers bemoaning their lot, that their work and their brands are not appreciated, understood, and their contribution not fully recognised. So what can they do about it? How can brands properly be recognised in the boardroom and indeed on balance sheets? I've got four experts who are going to offer a different perspective on that with me this morning. So welcome, guys. Let's get straight into it. And if I could start with you, Ian. You're responsible for unpicking success for investors as an analyst. And I think I'm right in saying you also have run a course, or do run a course, about speaking language that your CFO would recognize. So for all of these guys who are communicating currency as brand engagement or brand love, what is it that people in the boardrooms, investors, actually want to know about brand success? Strip it right back for us, will you?
So I think, well, actually, let's start off with Warren Buffett. And I think this sort of links in with the power of brands and the need, as it were, to invest longer term rather than taking a short-term approach. I don't know how many people in the audience know this, but Warren Buffett made 99% of his wealth after the age of 51. And a lot of that was due to the compounded effect of his investments. And there's a similar sort of analogy here with brands. Brands take a long time to build and so forth. And investors realize that as well. You can't just take a short-term approach. You also need to take a long-term approach to things as well. Now, are investors thinking about that when they look at brands? I would say, actually, in some ways, things are moving a lot more positive. So if you take what's happened over the past 2 years, I call it a vast unplanned experiment in showing the power of brands. Why is that? Go back 2 years ago, many consumer-facing companies said, we cannot get the level of price increases through to consumers that we need to offset the price inflation that suddenly came through very, very rapidly. And what they found was that they could do that and more. And the reason, if you listen to company conference calls with CEOs and CFOs when they talk about this, the number one reason they mention by country mile is the strength of the brand enabled them to do that. So there's a direct relationship there between essentially brand strength, financial power. We did some research with the IPA that looked in terms of analysts and investors' views, how they viewed of advertising and promotion. The top answer in terms of determining whether a company determines the strength of a company from an analyst and investor standpoint was the strength of its brand, above the of quality of its management, above the other metrics. That's all positive. Now, there are some of the things, though, that you have to bear in mind, which are more negatives. One is investors tend to take a rather short-term view of things. And this is also something we found in IPA research, that essentially the problem with a balanced approach is pressure coming on CEOs and CFOs of investors because, I won't swear, but effluent travels downwards. And so if you look at CEOs and CFOs, who are they most under pressure from? Analysts and investors. If you look at analysts and investors, they have to justify the stock investments they've made. And particularly when you look at an analyst role, and I think this is one of the most underappreciated factors, but it is critical in terms of this discussion about advertising. There are fewer and fewer analysts covering stocks, so they do not have the time to actually look at A&P sort of it in more detail. I'll end on one final point as well, excuse me, which is also negative as well. And I think I'd almost tie it back in with sort of the comment about the UK brands in a way. Yeah, I always remember the CFO, ex-CFO of a FTSE 100 company, telling me that essentially they loved going to the States to see investors because investors in the US realized that the role of the capital markets was to provide capital to grow. So when they came back to the UK and spoke with investors here, what people were concerned about was capital preservation, not capital growth. So there was an emphasis on dividends, share buybacks and so forth. And again, that's another factor that when we're thinking about investors and the sort of priorities they think about in terms of marketing, also needs to take into considerations as well. But overall, if I would look at things, I'd say the trend is moving in a more positive direction.
Yeah. I mean, I've read a lot of those, not that I spend all my time reading financial statements and looking over transcripts, but it tends to be the large, marketing universities, the marketing organizations, the FMCG giants that are making the point, and making the point very well, that brand matters. It affords all of or many of the things that you've just mentioned there, and we'll go on to discuss in regards to things like pricing power. And obviously the last couple of years have highlighted the need for strong brand to be able to justify larger prices. But there are a lot of people, I'm sure, in this room, and a lot of organizations perhaps who don't have the same faith put in them in terms of the boardroom. Annabelle, I mean, you work for a large and very renowned marketing organization in Virgin Atlantic that's built out and in a category where brand is absolutely important. It'd be really great to get your, cautionary tale as much as success stories about how you make that case for brand when you're pitching for investment, looking to justify and communicate your value. What kind of challenges do you face?
I think we've just touched on one of them, definitely the pressure that everyone's under day to day, and the short term versus the long term. But I think there's a bigger thing if you just sort of zoom out of that and think about how do you connect the direct relationship of what the brand is doing and the activity, what it stands for, the activity in the world, and how that directly relates to business outcomes. And I think when you can hold that conversation, which I think links into your second question about, well, what are some of the things you can do? I think an investment story is part of that, and that can be, what is the opportunity we're going after? It could be the burning platform, depending on your audience. And I think being able to then be really transparent about the building blocks of that, open the storybook, share the detail about what it's going to take, the trade-off conversations. And I think engaging in that, both from a commercial returns perspective and how that's going to deliver revenue, and the evidence around that is certainly an important point. If you think about the CFO, I don't think we can debate that demonstrating the ROI is got to be part of the conversation. But I think it can also be broader than that. The broader, if I think about the outcomes beyond commercial and people engagement, the whole workforce engagement, you think about the power of brand there. And I'll talk to one example with, Virgin Atlantic when we launched See the World Differently, the impact on talent attraction, people applying for roles, and what that resulted in for a long period of time was seismic for the business. We had, for every application, a tenfold increase in the number of people that wanted to come. And I think that was, not planned for, but just, drew the conversation around the outcomes, around the pride, and what does that translate into people's performance and the motivation and the customer service and the front line and customer satisfaction. So I think linking those conversations more broadly is part of how to engage everybody in the boardroom.
Yeah, so linking it to an actual tangible outcome that they would recognise as success. I mean, Claire, you've worked for media organisations both that are reliant on attracting brand investment, as well as obviously making the case for investment yourself. Similar question to what I asked Annabelle there. What challenges have you faced and how have you learned to overcome them?
So I think, to Ian's point, I think CFOs and CEOs are very different. So some of them get marketing and the value of brand, And if you work in one of those organisations, it's joyful and it's actually quite straightforward. And others don't understand it at all. I think, so one of the most important things, to kind of Annabelle's point, is understanding the different people in the boardroom and understanding their motivations and understanding their concerns and linking what you're doing to how you're helping them. So as an example, one of the challenges I had where I had to convince the CFO to spend money on a climate action plan, and how do you link it to his motivation? What I talked to him about was the ability to achieve cheaper financing because of having a sustainability plan in place. And that was something that, he was like, okay, I get that. That resonates to me. It's the same with your point about talent acquisition. When you're speaking to the HR director, if you've got a really strong, appealing brand, they want to have, that's valuable for them. So I think it's about understanding the different people around the boardroom, what are their motivations, and how can your work tap into satisfying their needs. And then I think there's just bodies of work that we can draw on. So Burnett and Field and the work that Kantar does, I think there's loads of examples where we can take theory and to prove and to demonstrate the roles that brands have in driving and maximising profitability.
Thank you. Lawrence, obviously in your current role at the IPA, you are all things effectiveness to all people. Talk to me about, and I know that you've spent a lot of time looking at the triggers of success as well, looking at the IPA data bank. Ian alluded to the importance of pricing power. Can you offer any examples of what's been celebrated and lauded and stands out in the IPA's rich history of tracking these things that demonstrates the importance of strong brand equals pricing power?
Sure, I'll try not to go full geek. I've got a couple of historical examples and a couple of brand new ones, because it kind of is weird to me that we don't talk about pricing very often. So certainly my effectiveness logo has a nice reassuring sort of share climb. And we find it much easier to talk about growing share and winning over competitors rather than actually what we all do for a living, which is decommoditize our brands. That's the very core of what we do. And adding a little bit of value and encouraging people to pay a little bit more for whatever we sell is actually at the core of what we do. Now, the IPA awards only go to brand owners and agencies who can prove profitable return on investment. So it's no surprise that there's a lot of price effects in there, because Ian will tell you CFOs love price effects because price effects go straight to the bottom line. I think that's why they've enjoyed the last couple of years. So we do have a lot of pricing examples, but they tend to be like a happy outcome. We did this campaign that was designed to drive share, and look, our pricing really held up. In fact, we can charge a premium. And I find it weird that there aren't more cases with intentionality around price, given that it is the core of what we do. So the two old examples, Virgin Atlantic, very deliberately using advertising to change the cabin mix and move people to higher margin cabins. That's an intentional price outcome from comms. And then Audi, very deliberately set out over the 20-year course, because it is a long game. Vorsprung Duke technique wasn't just to encourage people to buy more Audis, it was to close the price gap between Audis and Mercedes and BMW. Very successfully done. But they're kind of outliers historically because they have intentional price effects rather than accident price effects. And the two from this year, I won't tell you what they've won because our awards are on Monday night, so probably matters more to me than most of you in the audience. But I've got two more household examples that have very deliberately used price. One is Yorkshire Tea, who set about becoming brand leader from being third or fourth in a category that was in terminal decline, still is in slow decline, but they absolutely didn't want to do that at the expense of premium pricing. So if you go into store now, Yorkshire Tea is expensive. You're still going to buy it, because we all love Yorkshire Tea, but they do not discount, and they do charge a premium, and that's a very big part of that campaign, is not just to grow share in the traditional manner, but to grow it at a premium price. The McCain paper is even more intentional. If you love your oven chips, you know you've got a choice. McCain and own label. And 10 years ago, they decided that they could either discount and get closer to own label pricing and sell more, or invest in brand building. And they invested in brand building, and the test of brand building, to the earlier chart, was the price elasticity of McCain chips. All right, so there's loads and loads of evidence, and I think there'll be more because we now live in inflationary times. So it's there, and CFOs particularly like it.
Yeah. Ian, you've made the case strongly for marketing spend to be seen as capital expenditure. Why is that, and how likely is it that that message is going to be heard increasingly?
Well, I mean, I think, why should it be capital expenditure? Because it's an investment. I mean, the way that always talk about sort of advertising it is intangible capex. That just as firms spend on physical capex, such as a factory or so forth to produce goods because they know they need the investment over the short to medium term, but it will generate much more in terms of longer term sales. It's the same also as well when we're talking about the brand, that you need to have that continual investment coming through. And it's got other sort of implications as well. Just as with a factory, for example, you need to keep maintenance. Well, I mean, you know that there's a sort of longer term cost if you don't. You know there's a need to update and so forth. Now, the accounting treatment at the moment is sort of plays against that. And this is one of these reasons why marketing spend comes under so much pressure when firms are looking to maintain profitability, because what happens is marketing is treated as a cost. It's 100% expensed in the year in which it is generated. And therefore, if CFOs, CEOs need to meet their financial targets in order to please analysts and investors, the simplest way to do it is to cut their marketing spend. Simple as that. Whereas, for example, you take IT spend, it's capitalized, written down over a number of years, there is less of an incentive there to actually cut your IT spend to meet short-term financial targets. Now, is this changing? I think for several reasons it is, which is the positive side. One is, go back to what I said before, the past 2 years, what it's taught CEOs and CFOs because of that issue with pricing power. It is, brand is critical. So that's one thing. I think also as well, what you're starting to see is not just from the financial community and CEOs and CFOs. Interestingly enough, the accounting standards sort of may be changing as well. So the International Accounting Standards Board, I know it's not exactly everyone's cup of tea, they have put out a proposal paper suggesting that marketing be treated as, certainly brand marketing spend, be treated as an investment and therefore capitalized. And if that happens, then that's going to remove a lot of the incentives for CFOs to cut marketing spend in the short term to meet financial targets.
We could have an entire session, as dry as it is, about said subject, but it is important. I would flag everybody to read an in-depth analysis that we published on Marketing Week a couple of months ago on said subject and why it's important and what changes it will make. I can't believe it, but we're almost out of time. But just building off what you just said, Ian, and I'd like to get a closing thought from everybody on this. Yes, it's not utopia, I appreciate, but a lot of people, and I speak to a lot of people who, what they do is seen as discretionary, especially this time of year if you're entering a fourth quarter and things haven't gone quite as well as everybody forecast at the beginning of the year. So marketing spend is going to get cut. So a final thought from everybody as to how to challenge, mitigate that. If there is one thing that you would advise these good people here to do to get brand in the boardroom, what would that be? I'll start with you, Annabelle, if I could.
I think it would be recognising that there is nothing that can unify the entire effort of the organisation, or the people in it, or the plans in it, in a way that brand can. And I think if you can focus on that, and similar to what I said before, joining up all of the parts of the plan in that way, then it becomes really tough to challenge that, because it does so much for the entire business.
I feel like an amen is worthy after that. But Claire, your thought, final thought, please.
I think it's about really proving the value of the brand as a strategic asset. And I think you can do that in really simple ways, and they can be through numbers and they can be through visuals. I thought that Oasis number was really interesting when you looked at 150 to 355, and you very clearly go, well, that's the power of that brand. And so I think when you're communicating the power of brands, it's doing it in a way which is very memorable, and numbers and images can be a really good way of doing that.
Well, the questionable nature of dynamic pricing, one of the...
Well, yeah.
Lawrence, your final thought, please.
Just you've got to be the voice of long, because the problem we all face is that financial reporting and brand building run over completely different time horizons, and everyone else in the boardroom is talking short. They're talking about the next quarter. You've got to be the voice of long. Brands are built over decades, and businesses are measured over quarters. And you've just got to call that out over and over again before you can even have the other conversations, because that's the difference between what you do and what other people around that table do.
Ian?
Well, look, I'm going to be biased, but I mean, it's you've got to speak the language of the CFO, the CEO, and the board. I mean, you have to put in terms of marketing and brand spend. It comes back to what Claire said before. You've got to understand their priorities. You've got to actually work out, okay, what is it that they're looking at, what pressures they're under, what are the strategic directions of the company, and then you say, okay, how does marketing fit in with that? What I do, how does it deliver into that grand plan? And if you can do that, then I think you've unlocked the key to success.
Thank you very much. A cut out and keep guide to getting heard, understood and appreciated in the boardroom. Thank you very much to our fantastic panel.